Hello and welcome to another weekly news summary from Ferrari Financial. Well, it was a very volatile week on Wall Street. In fact, at one point the market was 1.6% down on its low, and another day up 3.1% at its high. The main driver this week really was credit concerns and liquidity issues. In the end, the stock market posted a slight loss for the week of about 0.5%. But news that a major investment bank needed a bailout caused the market to lose enthusiasm over the new tool that the Federal Reserve is using in an attempt to improve liquidity. The week started on a down note, and there was a number of negative items regarding financial institutions. But weighing on stocks was a Wall Street Journal report that indicated the FBI was investigating Countryside and up to 15 other subprime lenders for securities fraud. Freddie Mac and Fannie Mae lenders were also clipped during the week due to an article in Barron's that mentioned these institutions in a rather negative way. But the big news, I think, this week was really Bear Stearns, that it was facing liquidity issues, a liquidity crisis, in fact, and this really did drop the stock's value. So with the stock market losing about 0.5% this week, we do still have this breakout to the downside in place. Let's take a look at our Nasdaq Composite Index chart, where we can see that the recent consolidation pattern has in fact broken down to the downside. We're going to take a look at the one-year chart now for the Nasdaq Composite Index. We want to focus really on the events of the last few weeks, where we've had this massive sell-off really since the beginning of the year. Really from just before Christmas we had this continual sell-off right the way down till the Nasdaq actually just above the 2,200 mark. At 2,208 was the worst level before we had the pullback that we've had in the last week or so, on the promise of a nice fiscal package with some tax cuts, and of course the Federal Reserve stepping in with an interim interest rate cut, followed by further cuts at their end of January meeting. And this very nicely pulled the market back up, as you can see here, coming back up to this line, this brown line, which is in fact the long-term 200 moving average. This is a long-term average line, and when you see that penetrated, that's always a bad sign. We're back up to it now, but we do feel that if we look at the trend line that's forming, possibly covering the peak, and then across the pullback that we had just before Christmas, we're heading down at an angle of something like that. If that's the case, I'll just set that in so you can see it. There we go. Oh, one more try. There it is. Now, if we see this pullback coming back up to about, at the most, about 2,500, then we're back up to where that trend line would intersect it around about here, and that's probably the danger point where this market could turn south again and continue what would be a much more prolonged downtrend. We do think this is probably the scenario going forward into the spring and early summer, because we do feel that we've seen the head and shoulders pattern fully developed here. The right shoulder, the left shoulder here, followed by the head pattern, and then the right shoulder forming just before Christmas. Now we've had the penetration of the long-term average line, and we do think that in a classic scenario we would see a little bit more of a pullback of consolidation over the next few weeks, before then the market would probably turn southwards again. So the market ended down about 0.5% for the week, and this meant that really the consolidation phase that ended last week with a breakout to the downside was really still the focus of the market. It was moving downwards really because of the liquidity concerns that showed themselves this week. But after the bad start to the week, the next day credit concerns did seem to subside, as stocks posted their largest one-day percent gain since 2003, basically on the news of this coordinated central bank effort to improve liquidity. Basically, the Federal Reserve announced a new term securities lending facility, affectionately known as a TSFL, where the Fed will lend up to 200 billion of Treasury securities to these primary dealers, secured for a term of 28 days rather than the usual overnight facility. This certainly did lift the markets for a short time, but by Friday night we saw the selling continuing again, and the market ended fairly subdued. Well, all eyes will be on the Federal Reserve again this week because the March meeting is scheduled, and we expect the Federal Reserve to cut interest rates again, at least half a percentage point, but I feel now the market consensus is more likely for a 0.75% cut in interest rates. If this happens, then of course the market will probably be quite happy, and the market will probably rally a little on that news. And certainly, with a cut in interest rates of that magnitude, the general economy should receive a lift going forward into the summer months. Well, we'll be watching very carefully for the Federal Reserve announcement, but until next week, it's goodbye from London.